Hi, good morning. I'm Olmstead, and I'm joined by Brian Rudisill, one of our senior portfolio managers and traders. And Brian, we've had a lot of action this morning, and we want to briefly talk about that. I do have to read a compliance statement first. The information provided here is for general information purposes only, and all expressions of opinion here are subject to change without notice in reaction to changing market conditions. So Brian, now that we got that out of the way, let's talk a little bit about what happened this weekend with Silicon Valley Bank. As I understand it, Silicon Valley Bank was the bank for technology startups and IPOs in the Valley, for all things technology. And they started gathering a lot of deposits 2 years ago, 3 years ago, when money was relatively cheap at zero interest rates, and they just had an explosion of deposits from venture capital firms, from companies that went IPO, and they raised billions and billions of dollars. At that particular time, Brian, interest rates were close to zero. I don't know what the 10-year was, but
I think they said they invested somewhere around 1.7%, so a lot lower than current rates.
Yeah, so what they did with this explosion of deposits, Brian's absolutely right, is they invested in long-term treasury notes and long-term mortgage-backed securities right when the market was low yielding and interest rates were around zero. So Brian, I think you're right. I think the average yield on their portfolio is 1.6, 1.7, which was a relatively low yield. After that, they this past week had to sell some securities and take a loss on it because interest rates went up, and that affected their capital position. And unfortunately, the Silicon Valley depositors all seemed to get together on Twitter or Facebook or email, and they were worried about the capital position of Silicon Valley Bank, SVB, and there was a run on the bank of about $42 billion in runoff from deposits on Silicon Valley Bank. And with that, they could not raise the capital, so the Federal Reserve came in and closed the bank late Friday afternoon. And since then, we've had a little bit of a bank contagion, a little bit of this fallout to some other West Coast banks, and including Charles Schwab, which is an investment banking firm and custodian. Brian, tell us a little bit about what the Federal Reserve did this weekend to come in and backstop some of these deposits.
So with FDIC insurance, before all the action they took this weekend, your deposits were only guaranteed up to $250,000. But so this weekend they came in and said, all right, we're going to guarantee all deposits no matter the size. And that was the big thing with Silicon Valley, is a lot of their deposits were in the millions, and so they were uninsured. And there's the same issue with some other banks on the West Coast in particular. So they increased the guarantee basically to unlimited for the next year. And then at the end of the year, they're going to see if they need to extend that more, if they can go back to the 250. They did a few other things too that we'll go into the details, but that will help with the liquidity from some of the banks that have similar balance sheets to Silicon Valley Bank.
Right, I think that's a good point, Brian, that they had a lot of what we call wholesale or corporate deposits. And when these depositors got nervous 2 or 3 or 4 days ago, then they started pulling the money. And then also they had to continue to sell their longer term securities and take even more of a capital loss on that. So I think this is, Brian, I think this is pretty, this is really specific to Silicon Valley and Silicon Valley Bank, don't you? I mean, it's kind of West Coast oriented, and specifically for Silicon Valley Bank, which had all these venture capital funds in there and depositors in there, don't you think so?
Yeah, I agree. There could be a few more banks on the West Coast maybe that have to get taken over by the FDIC, but I think the backstop they put in this weekend, there could be some pain for those shareholders and bondholders, but overall I think the financial market and the stability of that is looks really good now, given the actions the Fed took.
Yeah, and we're seeing the equity markets a little bit higher today. We've seen some of the bank stocks like Bank of America, JP Morgan down 4 or 5%, but not down a lot. So can you comment on that?
Yeah, I mean, some of the regional banks, like a Comerica or some that have a higher uninsured deposit that we talked about, or less retail deposit, they're down more. But I think these big banks like Bank of America and JP Morgan are in great capital positions. They may actually see their business increase. So I think the overall health of the system looks pretty good right now. And despite the stocks can trade off in the short term, I think long term there's some good value there at some of these well-run banks.
Yeah, and Brian, you mentioned in our meeting this morning, this is not going to get over today. It may take 2 or 3 or 4 weeks, but we anticipate 4 weeks, month and a half, things are going to be back to normal. The Fed will come in and help any of these banks that have some runoff and have a few little problems. But in general, the banking system is very, very sound with a lot of capital and a lot of risk management ideas that are out there. Is that right?
Yeah, I agree. In the short term, people just get some panic sometimes. They hear these things about bank runs and think it's back like 2008. This is certainly not anything like that. It was a big credit concern then, and these weren't deposits we were talking about. These were just bad assets on people's books back in 2008. So we're not like that. But people remember that, and I think we're seeing some short-term panic for the next, like Don said, next 2 to 3 weeks maybe. Then things will stabilize, and people recognize that some of these bank stock prices offer some good value.
Good, thanks, Brian. And let's switch gears a little bit. Let's go to our custodian, Charles Schwab. Now, we do on our annual compliance review, we take a look at Charles Schwab on an annual basis, and we look at things like liquidity. We look at items such as their Moody's and Standard & Poor's rating, how much debt they have outstanding. I know, Brian, you do some work on some of their trades and how they execute these trades. And so let's talk a little bit about our custodian, Schwab. They have been lumped in with the West Coast kind of banks, I think unfairly, and their stock is down a little bit today. But from a safety and security standpoint, Schwab doesn't have any of the loans that SVB Bank did, and they've got a securities portfolio that is a lot shorter in maturities and shorter in duration if they needed to sell. And they're well capitalized right now. Any other thoughts on that?
Most of their loans are margin loans or maybe some mortgage loans or things. So they're very conservative loans. These aren't like high-risk corporate loans or venture capital loans like the problem was for Silicon Valley Bank. So they're in very good capital position. It's just a short-term panic where the market's selling anything that's even tiny bit related to Silicon Valley Bank.
Yeah. And I would also say Schwab has an $80 billion line of credit with the Federal Home Loan Bank. So they've got plenty of liquidity. They do not have any exposure to Silicon Valley Bank or Signature Bank, which was a crypto bank. And most of their deposits are retail deposits, which tend to be stickier. So we're very comfortable with Schwab as our custodian. They've been our major custodian for 23 years, and we're very happy with their service and do review them on an annual basis. Switch gears one more time, Brian. Banks are down today. Equity markets are doing a little bit better. Any thoughts on any opportunities out there within the financial sector?
We've taken this opportunity to look at pull up a few names and do a little screening, and look like there's some good opportunities for banks that have been very conservative, well run. There are a lot of banks that made it through 2008 without any government assistance, and they're down 30 and 40% from their highs. So I think we have more work to do, but there could be some good opportunities.
Good. So I do want to end and just say thank you all for your confidence in Navarre Capital. We appreciate your business. We appreciate your support and your confidence in the firm. This does provide us with some opportunities, as Brian says, to look in the financial sector and see if there's any names that have been beaten up that we really like that'll have a good return profile. Certainly, if you have any questions concerning Schwab or concerning anything in your portfolio, please reach out to us. via email or phone call and let us know what that is. We're happy to help and happy to give you our perspective on it. And again, thank you for your business.